there are proposed big changes coming to lease accounting. The equipment finance industry provides approximately $750 billion annually in capital to U.S. businesses for the use of income-producing assets. It is reasonable to expect that these proposed changes will have a significantly negative impact on businesses, the economy, and jobs, as small and medium-sized businesses lease the most, and they create the most jobs in the U.S. The following video will provide a general overview of the proposed changes, how they could affect business, and finally, what you can do about changing the direction by making your voice heard. The public comment period for the final joint exposure draft expires September 13, 2013. To give you a brief history of the project, in 2005, the SEC issued a report highlighting off-balance sheet operating lease obligations as a major financial reporting issue. This report prompted FASB and IASB, who were already working together on an initiative to converge accounting rules worldwide, to put a lease project on their agenda in 2006. The prime objective of this project was to capitalize all leases on lessees' balance sheets via a method that eliminated the need for users of financial statements to underestimate the debt-like value of operating lease obligations. In 2010, the first exposure draft, known as Project 1850-100, was issued by FASB, and it received 786 mostly negative comment letters, leading to some significant changes. In May 2013, the second and final exposure draft, or Project 2013-270, was issued, and the window for comments from the public is still open until September 13th. The proposed lease accounting will replace current GAAP, FAS 13 as modified by FAS 98, EITF 97-10, 00-13, 01-8, etc., which uses a 4-question test to determine whether a lease is considered operating or capital, will be eliminated. Is there an automatic transfer of title of the leased asset? Is there a bargain purchase option of the leased asset? Is the lease term equal to or greater than 75% of the leased asset's economic useful life? Is the present value of the minimum lease payments equal to or greater than 90% of the value of the leased asset? Generally, if any of these 4 questions come back yes, the lease is considered a capital lease, equivalent to a loan to buy the leased equipment. However, if all the answers are no, it's an operating lease, equivalent to a rental of the equipment. So, what are the proposed changes outlined in the current exposure draft? The proposed changes will require lessees to recognize on their balance sheet all leases that have a term greater than 12 months as right-of-use asset and lease liability, measured at the present value of future lease payments. Lessees may elect to exclude short-term leases of 12 months or less. For the income statement, a dual model is proposed that considers the type of asset and the consumption of that asset. If it's Type A, financing model, lessees report expense as interest and amortization. This will front-load expense in earlier years of the lease term, since the interest expense will be greater in the beginning, as it will be based upon a higher principal amount, much like a mortgage. Practically speaking, almost all equipment leases will be Type A, unless the lease term or present value of rents is insignificant compared to the useful life or value of the asset respectively. And this is a bad thing, as it does not represent the true nature of most equipment leases. Under the Type B model, lessees report expense on a straight-line basis. In other words, as the average rent expense. All real property leases will be presumed Type B leases, unless the lease term is a major part of the useful life of the asset, or the present value of the rents equals substantially all of the value of the asset. In transition, nearly all existing leases will need to be rebooked. In other words, restatements going back 2 years. Lease payments for the lessee will include all contractual payments. Any purchase or renewal option where the lessee has an economic incentive to exercise the option, termination penalties if a termination is assumed, variable rents based on an index like CPI or a rate like LIBOR, and expected payments under the value of residual guarantees, if any. When lease payments include other services such as maintenance, such non-lease cost components must be bifurcated. Not an easy thing to do. All sale leasebacks with purchase options at any amount less than the sales price will not be treated as a sale, but as a financing, which is bad because non-bargain purchase options should not negate sale treatment. It will not represent the true economics of such deals. Type A leases will require complex adjustments. All sale leasebacks will have to be reviewed to determine if a sale falls under the new rules, which is a costly exercise. And capital leases will be grandfathered. The only good news so far if you're keeping score. These proposed changes may have serious economic, operational, and accounting implications. There would be technical breaches in contractual arrangements, such as debt covenant breaches due to the labeling of lease liability as debt, although the credit standing of the lessee will remain unchanged. There may be detrimental impacts to bank capitalization, capital formation, and the ability of businesses to borrow. There may be a reduction of equipment and real property values, adversely affecting lenders. The front-ended impact of the cost treatment for Type A leases is, in effect, a cost increase in the first year of the lease of between 7 to 28%, depending on the lease term, that could result in cost-cutting in other areas of the business, which would have a huge impact on business equipment sales in the USA, negatively affecting the economy and job growth. The new accounting standards will result in more confusion than clarity, and the costs of implementation and compliance will far outweigh the benefits. Purported benefits which have yet to be proven in a convincing manner. Here is what other people are saying in their comment letters to FASB. If existing standards are not broken, don't fix them. A lease is a lease is a lease and should be accounted for as such. It's perplexing to read that FASB is finding general support. I am active in the CFO community and haven't come across anybody who is supportive of the proposed change. If you're going to pursue this fiction, why stop with leases? Why not require every organization that hires a new employee to recognize an asset and liability equal to the compensation of that employee over the estimated employment period? That way, companies could add trillions of dollars to their balance sheets. I guess we will need to do the same with utility expenses, telephone expenses. As a matter of fact, why don't we just go ahead and estimate the net income of an entity for the rest of its life and capitalize that? Alright, so what can you do to influence the detrimental outcome of these proposed changes? First, read the second exposure draft. Next, read the comment letters to see what others are saying. Then, send your own comment letter. Look, the first exposure draft was meaningfully changed after 786 comment letters. The second draft to date has only received 30 comment letters. Your influence counts. Head over to CG's Lease Accounting Resource Center at cgcommercial.com/resource center for links to the current exposure draft, white papers that detail issues within the draft, plus existing comment letters and tips for writing your own comment letter. Don't forget, you must send your comment letter before September 13th. You have a voice. Now use it.